Hey. Hi guys. Welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, veteran stock markets and derivatives trader, analyst at Cointelegraph. On today's Macro Market show, we'll be explaining why the US Federal Reserve is set to lose $100 billion. Next, we'll explain the relationship between the Ozempic drug and cryptocurrencies. Today's show will start by discussing the US Federal Reserve losses. According to the Barron's headline, the Fed is heading for a $100 billion loss. It is making plenty of investors winners along the way. It is actually pretty funny when you step back and look at it. Here's the Fed, which is trying to tamp down inflation and slow down but not crash the economy, raising rates consistently for 18 months. As a result, all sorts of individual and institutional money market fund investors have seen their income soar, but the Fed itself has been losing lots and lots of money. So, rule number one in macroeconomics: there's no way for everyone to become wealthier, as the prices of goods and services will naturally follow the higher demand. And even if the inflation doesn't instantly increase for other reasons, the odds are that scarce assets price will increase. So it becomes harder for one to acquire the same stake in companies or real estate. In that sense, yes, people are getting more dollars in their bank accounts and investments, but their share in global goods, service, and assets remains the same. That's why we see so many videos of families earning over $100,000 unable to cover housing, food, education, and health. That's because even if the inflation returns to the Federal Reserve's target of 2%, that doesn't mean that prices will decline or that real estate prices will go back to the same level from 3 years ago. Now, back to the Barron's article. The Fed's 12 regional banks, which used to make a lot of money, are now running big collective deficits. That's because they're paying more than 5% on trillions of dollars that they've borrowed from money market funds and other financial institutions, while their own portfolios remain loaded with low-yielding mortgage and treasury securities that they bought during the days of the near zero interest. So one begs the question, why would the Federal Reserve acquire assets such as mortgage-backed securities and bonds? They did it to support the markets and the economy and avoid a recession in 2020 and 2021. And during that time, the yields were extremely low. Now that the Federal Reserve raised interest rates, those investments are worthless. As the Barron's article nicely puts it, as of June 30, what the Fed calls a deferred assets, but what I call losses, totaled $75 billion, according to the Fed's recent financial report. The Fed Bank's combined profit remittance to the Treasury through June 30 were a mere $102 million, down more than 98% from the $62.8 billion remitted through June 30 of last year, before the rate increases began to seriously affect the financial markets and the Fed Bank's profits. So the Fed is basically no longer sending profits to the US Treasury. And that's an essential job of the Federal Reserve, generating profits for the US Treasury. After all of those assets ultimately belong to the Treasury, since they were financed by debt issued from the government in the first place. However, you can notice that such profits have evaporated since the interest rates begin to increase. The author explains, the Fed bank losses don't increase federal budget deficits, but the now vanishing big profits that they used to send the Treasury did help down the deficit, which is $1.6 trillion so far this fiscal year. So we're heading to a $1.6 trillion deficit for 2023 in the US. That's obviously not sustainable, regardless of the debt currently standing at 10 trillion or 32 trillion, which is the current number. Sure, one can blame the Fed for raising interest rates in the first place, but without that, inflation would have never returned from the 9% peak, and the cost of living would have skyrocketed. So the huge pile of money that investors deposit on short-term bonds and money market funds is a reflection of the trillions of dollars injecting during the pandemic years. The Fed and the US Treasury are now paying the bill for such a loose monetary policy, or as I call, lunatic monetary policy. You cannot distribute money to everyone and expect these things not to happen. That's just crazy. I completely agree with the author's conclusion. I don't know what the future holds for money fund investors, no one does. But for now, they are profiting substantially from the Fed rate increases. So if you have substantial money market fund accounts, it's time to be happy. Yes, right now the inflation, at least nominal, is near 3%, and the short-term bonds are paying over 5%. That's obviously positive for the investors, but unsustainable. If the Fed does nothing, the government will run out of funds and be forced to turn on the printer. If the Fed reduces interest rates, the demand for borrowing will increase, so it accelerates the economy instead of decelerating, so potentially triggering inflation. Either way, odds are the fixed income gains can last for another 12 to 18 months top until the Federal Reserve is forced to act. Where will the money flow? Stocks? Bitcoin? Real estate? No one knows, so make sure to stay financially alive until then, so don't use leverage or do stupid stuff. Just to highlight, that's my own personal opinion, it does not necessarily reflect Cointelegraph's official view. Now, let's move to the European markets. The CNBC headline reads, weight loss drug maker Novo Nordisk vies to become Europe's most valuable company, topping LVMH. Danish drug maker Novo Nordisk on Friday briefly overtook French luxury goods giant LVMH to become Europe's most valuable company. Novo Nordisk produced blockbuster weight loss drugs Ozempic and Wegovy, which have generated massive hype over the past year. Its share price has more than tripled over the last 3 years and has gained 66% over the last 12 months. Wait, there's more. Denmark on Thursday revised its GDP annual growth forecast to 1.2% from 0.6%, citing a boost from the pharmaceutical industry as a key factor. I have no words. People do memes about some economies being based on weird industries, but that's the first time I hear a weight loss drug is causing a country to double its estimated GDP growth. But first, let's take a step back to understand what the LVMH group is. So according to the CNBC article, LVMH, the group behind brands including Louis Vuitton, Moët Chandon, and Tiffany, has seen its share soar to record heights over the last 3 years, as luxury spending has remained resilient. Its CEO, Bernard Arnault, is one of the world's richest people. However, its share price has declined in the recent months as expectations over a rebound in Chinese travel and spending have cooled. Now, Novo Nordisk, the pharma company, has $11.2 billion in annualized net profit, which is smaller than LVMH's $15.6 billion, but it has a much higher margin, 35.5% versus LVMH 18%. So the pharma company has less revenues, less net income, but has a much higher margin, double the margin. That's a key ratio for investing, since the pharma company is more capable of withstanding a recession without becoming unprofitable. Now, what does that have to do with cryptocurrencies? Well, besides the obvious reasons of competing for the same money in terms of store value, the networks and protocols using smart contracts can also be priced in terms of how much revenue they generate. Now, I'm not questioning whether this analysis makes sense or not, since the income of the DeFi protocols and smart contract networks isn't directly distributed to the token holders. But there is potential for that. You can even track those revenues on websites such as DeFi Llama. For instance, MakerDAO, the protocol behind the stablecoin DAI, generated $10 million in revenue over the past 30 days, while Lido's staking service, after paying the cut to its depositors, still netted a $5 million monthly profit for the protocol. I honestly believe there's a future there, but I cannot guarantee that the current networks and protocols will be the winners. Still, I recommend everyone to keep an eye on those metrics because soon enough we'll have traditional companies being able to distribute earnings in crypto, as long as the revenue also comes in digital form, meaning there's a smart contract that splits the income generated regardless of what the actual management of the company wants. So yes, the sector is promising, but right now it's pretty immature and complex whenever it involves real-life assets, corporate structure, physical items, and etc. So is the sector promising? Yes. Is the investment worth right now? I honestly doubt it. Well, that's it for today. Hope you guys enjoyed the show. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. See you!